If you feel like some of your setups don't work, or price keeps moving in your predicted direction after hitting your stop loss, the problem isn't your analysis. The problem is not seeing the liquidity. Because if you can't identify liquidity, you become part of it yourself. In this lesson, you're going to learn 4 of the most important liquidity setups. Setup 1. This setup is the most common type of liquidity setup. In this pattern, as the price moves toward the order block, it creates liquidity along the way. In a sense, it's building a liquidity pool. In fact, the price is intentionally manipulating the market, so that at these levels, because of trend lines or repeating highs and lows, traders start opening positions whose stop losses are placed exactly in these same areas. Now, here's the interesting part. When the price finally reaches our desired order block, it consumes all that accumulated liquidity, essentially refueling itself to make a strong reaction to the order block and begin the main movement of the market. Setup 2. This setup is the weakest type of liquidity setup. However, the key point is that when you combine it with the first setup, your analysis power and entry precision increase dramatically. In this case, as the price retraces back toward the order block, it starts creating new liquidity. This liquidity usually acts as the next target for the market. The market first reacts to our order block, and then, in order to consume that newly formed liquidity, it continues its movement. Setup 3. This setup works in a way that the price collects a lot of liquidity before starting its move. It's like refueling for a new trend. And then, with the change of character, it gives us the entry point. For example, the price was building liquidity between these 2 trend lines. If you were trading based on patterns, you would probably see this as a beautiful triangle pattern and might enter a buy position after this breakout, and later a sell position after the other breakout. You would likely hit your stop loss both times. But based on the concept of liquidity, once you recognize these trend lines, you realize that the price was actually collecting liquidity both below and above them. What happened next is that the price moved upward, taking out the liquidity above, and then dropped down, taking the liquidity below. This pin bar candle confirms all of this analysis. Its long shadow means that the price swept liquidity and came back. The fact that price took liquidity from both directions means it has collected a lot of stop losses. Essentially, it has refueled and is now ready for a new move. But what kind of move and in which direction? The price signals an intention to move upward with this change of character. Now we look for an entry, and by spotting this flip, we can confidently enter on this order block. Why confidently? Because this change of character and this entry formed right after this beautiful liquidity setup. Even traders who are extremely selective about their entries would have been given an opportunity here. So, if you couldn't fully trust this order block earlier, this strong reaction and the clear flip confirm the entry setup. At this point, entering on this order block would have been the correct decision, supported by structure, liquidity behavior, and confirmation from price action. Setup 4. This setup is the strongest type of liquidity setup. In this scenario, after the change of character occurs, and before our order block is mitigated, the price starts creating liquidity areas on both sides, both above and below. With these upward and downward moves, the price practically collects liquidity from both directions of the market. After all this liquidity is consumed, the price then goes on to mitigate our order block. This means that before the price even reaches our intended order block, the market has already gathered a large amount of liquidity, fully refueled, and is now ready to make a strong reaction to our order block. That's why the 4th setup usually has the highest probability of success and offers the best risk-to-reward ratio among all liquidity setups. Another important point about this position is that it contains setups 1 and 2. That means after the formation of setup 4, we have setup 1 forming below and setup 2 forming above. This powerful combination makes the order block, which has not yet been mitigated up to its 50% level, even stronger and more reliable for an entry. One thing I have to say at the end is, don't try to use all these setups together at once. The best approach is to use the third and fourth setups separately, as each of them on their own is already a very powerful setup. However, if you want to combine setups, you can pair the first and second ones together, because they move in the same direction and complement each other. In the end, adding these setups to your strategy will help you identify liquidity much earlier. And instead of becoming a victim of liquidity, you'll be able to use it to make more precise and confident entries in the market. If this video was helpful for you and made your understanding of liquidity clearer, make sure to hit the like button so this content can reach more traders. Also, share your experience of practicing these same concepts in the comments below. As always, thanks for staying with me until the end of the video. Backtest with focus, and until the next video, stay successful.